Good morning, everybody. It's Wednesday, May 3rd, 5:30 a.m. Central Time as I speak here. Kind of a bloodbath in the grain markets again this morning. July corn futures down 7 1/4 at 572 and three quarters. July soybeans down 9 3/4 at 1401. July Chicago wheat down 3.5 at 605 and three quarters. July Kansas City wheat down 1 3/4 at 738 1/4 last. July spring wheat down 2 1/4 at 771 1/4. Mackenzie, let's start with the wheat market this morning.
SRW wheat futures fell to fresh 2-year lows yesterday. Spot month SRW wheat futures fell to a low of 5.95 per bushel, the lowest since April of 2021. Wheat traders are not interested in a Black Sea grain deal that could expire in 2 weeks. Drought in the HRW wheat areas of the U.S. Southern Plains has not helped price action. The market appears set on achieving price levels that stimulate demand.
Mackenzie, you would think that given the severe drought in our biggest wheat producing region of the country, that the market would act better, right?
You would think.
That has just not been the case, and the market doesn't seem interested at all in. And I know that I'm looking at an SRW chart here, but we've got big time problems in HRW wheat country. We've got potential problems in spring wheat country. Yet the market continues to decline. That the issue here, if there is one issue that I can point to, would be demand and global export pricing. Demand for U.S. wheat on the export market is close to non-existent. Our export program is very, very soft. Russia and other countries are able to offer wheat at lower prices. So the wheat market, I think it's seeking a level that stimulates demand. That's my thought. And what that level is, I don't know. Are we seeking feed demand or export demand? I don't think the market really cares, but we need to find a level that stimulates demand, and we have not done it yet. Large money managers' funds are holding a large and building net short position in the wheat market.
Oklahoma's wheat crop appears to be a complete disaster. A group of scouts pegged the state's winter wheat crop at 54.3 million bushels with an average yield of 24.6 bushels per acre following an annual tour. The tour included educators from Oklahoma State University in addition to other crop experts. Members surveyed at a meeting of the Oklahoma Grain and Feed Association painted a much more dire picture. They pegged the crop at just 40.7 million bushels, which would be the lowest since 1955. Kansas is the top U.S. HRW wheat state, and Oklahoma is often number 2.
These are two stories that should not be related. Futures falling to fresh 2-year lows, yet at the same time, your second biggest HRW wheat producing state is an absolute mess. These two estimates, so the crop tour estimate was a little bit more optimistic, this 50.3 million, which I think would be the lowest since 2014. There was also a drought in Oklahoma that year. But the other estimate, which is like, I guess the members of the Grain and Feed Association just kind of guessing, I don't know what this is based on. They're looking at a 22 bushel per acre yield and a 40.7 million bushel crop, which is, again, the lightest since 1955. So you've got an absolute disaster in a lot of U.S. HRW wheat country, but at the same time, the market continues to plummet. This is just a very, very bad combination if you're a wheat grower in the Southern Plains. This is not how you would have expected this to play out. You would think that the drought and these poor crop issues would result in some strength, and we just have not seen that at all.
If you guys are not already subscribed to our premium content, you sure need to do so. Joe, what did you cover yesterday?
It's not too early to capture carry, guys, on new crop bushels that you've already sold. If you've got December corn HTAs or short futures positions, that's what we discussed specifically yesterday. Now, the situation in regard to capture and carry has changed a little bit given this higher interest rate environment. There's a lot of things to consider. If you guys want to see this video that I did about this yesterday, go to standardgrain.com. Sign up today. This is a $50 per month subscription, morning email, text messages, new premium videos every single business day. It takes you about a minute to sign up on your computer or on your phone. All you need is your credit card. Sign up this morning. I'll send you out this. I'll send you out that crop insurance video from earlier this week. We'll send you Chris Barron's crop insurance calculator, a whole bunch of free tools this week as well.
So, Black Sea grain deal talks are expected to begin here on Friday. Russia's foreign ministry acknowledged that talks with the United Nations regarding the deal would begin in Moscow on May 5th. The overall tone has not changed. Russia has demanded sanction relief in exchange for an extension of the deal, which expires on May 18th.
Russia will not receive any sanction relief from the West. The United States is going to have to authorize any sanction relief, and they're not going to do that. The United Nations is going to kind of try to thread the needle here and see if they can make this extension work without sanction relief, which seems unlikely. We saw that story, I think it was last week we discussed it, that the United States authorized JP Morgan to help Russia to process some of these payments. Russia said that that wasn't enough. I don't know if Russia's bluffing here or not, but again, this is another story that could be considered bullish or friendly that the market has absolutely no interest in. And one other thing that should be noted, and we've discussed this before as well, this is a bigger deal for the corn market than it is for the wheat market, despite what you may have been told. USDA projects that this year Ukraine will account for about 6% of all global wheat exports, but almost 15% of all global corn exports. But again, neither market seems interested in trading these headlines anymore. Whereas a year ago, this was like the only thing that we traded. The tide has really turned here.
U.S. banking issues continue. Following the collapse of First Republic, which had been a top 20 U.S. bank by deposits, more banks appear to be in trouble. The stock prices of many U.S. regional banks continue to decline drastically. PacWest shares fell another 12% overnight after dropping 28% yesterday. Western Alliance Bancorp fell 8% following a 15% decline yesterday. Higher interest rates have been a challenge for banks. Many customers have pulled deposits in favor of higher yielding treasury instruments.
Okay, put on your tinfoil hat for a second. So the general narrative here has been that, there's been these like kind of bank run type scenarios. You can go get 4 or 5% with the treasury instrument, whereas the banks aren't going to pay you that much. So customers are pulling deposits in favor of things like that. And then you've got this like domino effect type thing where if somebody hears that there could be a bank run, it's kind of like a self-fulfilling thing. And of course, the banks, given this fractional reserve banking system that we have, they don't have the cash on hand to cover everybody's deposit should some sort of bank run ensue. Here's a chart that Bloomberg had this morning. This is the KBW Regional Banking Index. So I think this tracks like a group of bank stocks. I mean, it's ugly. It's down 28%. I think I don't know if this is year to date or whatever it is, but this is ugly, ugly stuff. A couple things to consider. The Fed is going to launch a digital payment system in July. Contrary to what you've been told, this is not a central bank digital currency. It is a digital payment system. Does this have something to do with the bank failures? I don't know. Some people might argue that. This is another thing. This is some recommended listening or watching for you guys that I would certainly check out. This is the Compound and Friends podcast, episode number 89. Ric Edelman was on, and Ric Edelman is a big time, well-respected finance guy. Here's a couple of the quotes that Ric had regarding this financial thing. He said, "This is an anti-crypto effort on the part of the regulators." He said this is an invented crisis designed to achieve an agenda that regulators have regarding cryptocurrencies. And he was talking specifically about Silicon Valley Bank and about some of the recent collapses. He thinks that there are ulterior motives here. And this is not a crazy person. This is like one of the biggest RIAs on the planet, essentially, or used to be. I think he sold his business. But you guys should check this out. I'll put the link in the podcast notes and in the YouTube description here. It's a long episode, but if you guys are interested in getting into some potentially crazy details, these are not my opinions, but I thought it was super, super interesting. I would check that out.
So oil prices took a dive yesterday over concerns about the economy. Oil prices sank 5% to a 5-week low on Tuesday as politicians discussed how to avoid a debt default and investors braced for another rate hike. May futures for Brent crude and West Texas Intermediate crude closed at their lowest levels since March 24th. Oil has weakening prospects as the U.S. and China deal with economic challenges. Analysts analysts at Barclays claim that the U.S. economy is evolving in a manner that suggests a recession will begin later this year. If the economy continues to deteriorate, momentum selling could send prices below $70 per barrel.
Yeah, we're already almost down to 70 here this morning, spot futures. Here's a quick look at a weekly continuation chart of WTI crude. If you take out this 65 area, on spot futures, good night. It's going to look really bad. So I think this is a bad thing for the grain markets. It's a bad thing for commodity market prospects. Some people think this is a precursor to a recession. And again, everybody's been talking recession for months. You look at the broader commodity markets. This is the Bloomberg Commodity Index on my screen. We are very, very close to posting fresh lows here for this entire move. So it's really been a fantastic decline that we've seen since these highs were posted about a year ago following Russia's invasion of Ukraine. We're down 27% from those highs in commodities as a sector, and this Bloomberg Commodity Index tracks a basket of commodities, including energies, grains, precious metals, livestock, softs, all of that stuff. So it's not a good action in commodity markets. So I think that there are some negative headwinds in regard to just general commodity price action that are probably affecting the grain markets here this week. Honestly, if you told me and you knew for a fact, Joe, these regional banking issues or these banking issues in general, they have something to do with the grain market action and the weakness there, I wouldn't be shocked by that at all.
U.S. job openings declined to their lowest level since April 2021. In March, job openings fell to a near two-year low of 9.6 million, a sign the U.S. labor market is cooling. The Federal Reserve would like to see job openings and hiring slow even further to ease the upward pressure on wages and inflation. The number of people quitting their jobs fell slightly to 3.9 million. Quits have tallied fewer than 4 million for 3 months in a row for the first time since 2021. The number of job openings for each unemployed worker slipped to 1.6 from 1.7 in February. That's the lowest level since October 2021, but it's still well above pre-pandemic levels of 1.2.
Yeah, there's still a ton of open jobs. Historically, we're super, super high. And again, we've talked about this, Mackenzie, we talked about this before. The Fed wants you to lose your job. And I really hate that that's the way that this functions. So we are citizens of this country, right? We pay taxes, yet the government wants to see a whole bunch of us out of work, which is not it's not the way that the government should function. I understand that their goal is to tame inflation, but you would think that maybe they'd be trying to take a different approach here. I'm just not a big fan of that idea that, hey, we've got to kill the labor market and push up the unemployment rate. There's all sorts of bad statistics out there about how, so many people lose their jobs that equals so many suicides, and it equals drug use and domestic abuse and all sorts of terrible stuff. It's not good that the government's pushing for this, but the job market itself, all that aside, is still very strong. It's in corrective mode, whereas it had been way too hot for way too long.
So President Biden has no plans to negotiate over the debt ceiling. GOP leaders have been invited to a meeting with President Biden on May 9th to discuss the debt ceiling, but only on his terms. Treasury Secretary Janet Yellen warned earlier this week that the deadline to prevent a default on the nation's debt could be as early as June 1st. While Republicans and Democrats hold their ground, the stock market is expected to decline substantially until a deal is achieved. Biden had been unwilling to speak with House Speaker Kevin McCarthy until House Republicans passed their own debt ceiling proposal last week. The White House is leaning on polls suggesting Republicans will take the lion's share of the blame if a default does occur.
The last part that you mentioned there is the whole thing. Who will take the blame? This is a sham. It's a political charade. The debt ceiling is a joke. They raised the debt ceiling an average of 1.2 times per year, and they have since 1960. This is not the government approving new spending. This is essentially just approving that they go into deeper debt to spend money that's already been appropriated. So back like in the Tea Party era, they turned this into like this big political thing where whoever was in power, if they had to raise the debt ceiling, then the other party would say, oh, you're spending recklessly, But all in all, this is just nonsense. We just continue to borrow money and go into debt, and that's just the deal. So I wouldn't read too much into this. I know that some people are concerned that, oh my gosh, if they don't do it by June 1st, we're going to default. I don't see that happening. I see this as a lot of noise about nothing, about something that happens on like an annual basis. I hope I'm right about that, because if we did default, yeah, absolute disaster. What about the cattle market yesterday?
The cattle futures were down hard on Tuesday. Live cattle futures traded anywhere from 150 to 197 lower. Feeder cattle futures completely fell out of bed. They were anywhere from 375 to 407 lower. Fat cattle trade has already been established this week. 7,000 head were traded in the South. Cattle feeders in Texas and Kansas traded cattle for 172 on Tuesday. That's $1 lower than last week. It's clear that the Packers have definitely regained some leverage. Box beef also had a down day on Tuesday. Choice ended the day at 309.24. That was down 78 cents. Select ended the day at 288.66. That was down $2.34.
Remember, guys, the Fed will be out at 1 o'clock Central Time today with a rate hike. In all likelihood, should be a quarter point. In the outside markets this morning, ahead of the cash open, U.S. dollars down a little bit. Stock markets marginally higher. Crude oil getting hammered down $2.09, 69.57 in the June WTI. Just can't hold a rally. I think that this broad-based commodity weakness is absolutely a negative for the grain markets. Everybody have a great day today. We'll talk to you same time tomorrow.